If you're a first-time home buyer with limited funds for down payment and low credit scores and you want to buy a home, you're going to want to hear this. If you're new to my channel, my name is 𝐷ianne.steffey. I am a mortgage loan expert, a passionate mortgage loan expert. I work with clients to educate them on the various financing options available to them. In this video, we'll be discussing FHA home loans and how it can help you to purchase a home. We're going to be talking about eligibility requirements, interest rates, fees, and so much more. There are pros and cons of an FHA loan. The pros is that you can buy more of a house using an FHA financing because you're allowed to go up to 57% debt-to-income ratio. The debt-to-income ratio is the percentage of your gross monthly income to pay for your mortgage plus all your liabilities. The con is that that mortgage insurance premium that you're going to be paying is for the life of the loan. The only way to get around it is to pay 10% down in order for that mortgage insurance premium to come off at the end of the 11th year. On an FHA loan, if you're trying to buy a home using FHA financing, but your income is not eligible, or you're a first-time home buyer, but you don't have all the income allowed or required, or if you're a student, a college student, and you don't have income, you can have a co-signer on your loan, which means that they can take the liability, the responsibility of making sure that payment is going to be made. Well, having a co-signer is a real serious thing. You don't want to co-sign for somebody who doesn't have a good history of payments. And so you need to really consider that seriously if you want to be a co-signer. For example, I co-signed for my daughter when we bought her a home in Stillwater, Oklahoma, when she was a college student. So that was a good thing, but I controlled who made those payments. So co-signers have to be very careful as to who they're lending their name to, because mortgage company is still going to report. So you want to make sure that those mortgage payments are being paid on time, because it's going to report to the credit bureaus. The downfall of being a co-signer is that if the primary borrower doesn't make their mortgage payments on time, if that negative reporting is going to be reported on your credit as well if you're a co-signer. So you have to be very careful about that. There's a liability if their property goes into foreclosure. When you are considering being a co-signer, you have to think about this very seriously before you put your name on that loan application. If you want to be a co-signer and you're going to apply for a home, if it's not greater than 12 months, you may have difficulty in qualifying for it. Of course, it still has to depend upon the income and the the income calculation, as well as looking at the debt to income calculations overall. So rather than to say that would be a bad thing, you would have to look at it by looking at the calculations of that particular monthly payment included in your debt to income ratio. If it's greater than 12 months and you have 12 months of proof that the mortgage is being paid by the primary borrower, then you're fine. Then the mortgage company who is doing your loan potentially will be able to offset that mortgage with those 12 months of payment history. The closing costs are delegated by every particular lender. So you may have lender fees up to $1,600. It all depends upon the lender. There are third-party fees, and we have no idea what the third-party fees are going to be once we have a client under contract. So it all depends upon the title company, insurance individual, if there's going to be a new survey. So every third-party vendor has a part in calculating or part of that particular loan. So it's hard to say. Sometimes it can calculate to be 3 to 4% of the purchase price, but it all depends on every specific lender. Interest rates are based on a number of factors: your credit scores, the type of loan, the term of the loan. So those are a number of factors that we look at in order to determine what kind of rate to give. Each particular lender has their own capital markets person who calculates or determines what the rates are going to be. It's all driven by that. FHA loans are great products, or a great type of loan to have, are a little bit more difficult, the type of clientele that we get. But one of the things that I want to make sure of when we talk about eligibility requirements is there a work gap, how long the person's been back on their job. We want to make sure of all those intricacies involved in getting a home loan. So FHA loans are a great type of loans. It's a product that is open up to low to marginal income individuals and those who have some spotty credit or don't have any down payment. So it's a great product to have or to use. Take advantage of the benefits of FHA home loans today. Contact me, find the link in my bio, and book a call with me today.